Hello everyone, hope you guys are doing well today. Today we are going to be focusing on a very unique, very small topic, that is liabilities and provision. Liabilities and provisions, we have a very small distinction between them. Okay. Now, basically provision is also a anticipation, or we can say it is an anticipation of a future liability coming in a business. What is a liability? Liability is an obligation that is on the business. It is an obligation that is on a business that is arising due to past event, past activities that we have done, we have conducted, and will result in a transfer of economic benefits, usually cash. Now, what do we mean by that? Now, if you understand, if you just think of your particular situation of your life, if you have utilized electricity, I'm sure, I'm guaranteed that everyone has. If you're utilizing electricity, you utilize it today, and the invoice of the particular electricity is coming to you at the month end or the next month start. Okay? So the charges that are written there are for the benefits of the electricity that you have utilized previously, right? And the particular benefit you have utilized, that is a past event. So past event is bringing you an invoice that is an obligation upon you today. Obligation of what? To pay the particular bill, and it will result in a future economic outflow. That means in the future you're going to pay that bill. So economic resource, that is cash, will be used up in this particular area. In simple words, a liability is anything a business owes. And a provision is basically a preparation of the particular liabilities that are coming in the business. Okay. So in the future, if I estimate that I will have a particular situation where my business is going to have a warranty claim, that is a basic loss for me. So in a provision, I will estimate the expense for that, and I will account for that or prepare my business owners for that, so that they don't get a sudden shock. The business is prepared for a particular liability that is coming up in the future. The preparation of liabilities is done through recording of provisions. Okay. So liabilities can be for current and non-current both. Current liabilities include any transaction that is to be done within 1 year. Non-current liabilities include anything that is to be done with more than 1. Non-current liabilities normally to include one extra component in it. When someone is giving you money for more than 1 year to utilize, to benefit from it, is going to charge you something, right? And what are the charges? The charges are known as, in simple words, interest. So you have to pay them interest, obviously, so that you can benefit from the particular situation. From the particular situation, what is the particular situation? The particular situation where you are utilizing the funds provided by them. So in this situation, you have to pay some profit to them, that is known as interest. Okay. Now, interest is a separate thing. Interest is normally known as an expense, right? An expense goes in P&L, profit and loss situation, where you have to basically show that this is the particular expense of taking out the money. Now, if I'm taking a loan, or any kind of current liability or non-current liability, any kind of non-current liability I'm taking in. If I'm taking a loan, I'm getting money. Yes. So I am getting capital for the business. That will be recorded in the SOFP normally and as equity component. On the other hand, with this particular situation, you have to show that the money that you have taken, you have to pay a cost for it, right? So interest is basically the cost of the capital raised, right? The capital that I have raised, I have to pay something in return for that. That will be recorded in the profit and loss statement as an expense. Okay. So the revenue generated from the money that I have taken as loan, I have to match the revenue with the interest paid. So that is a matching concept applied as well. So the matching concept can be applied here as well. Now, key presentations. Remember, in your statement of financial position, always you go from most illiquid asset to most liquid asset or liability. Okay. Now, in case of non-current liability, are we going to be able to pay off the non-current liability within 1 year? No, we are not. So if you're not going to be able to pay it off within 1 year, that means basically it is a liability that is going to be carried forward to multiple durations. If it is there for multiple durations, that means now it is non-current liability. Now, the liquidity or the, for we can say the cycles of the loan or non-current liability is not going to be run down to multiple times a year. So it is an illiquid asset where transactions are going to be lower in number. So it is presented first. First in the SOFP, you write NCA, you record NCA, and after that you go for current assets or NCL and current liability. So first of all, always, this is the presentation part of your particular financial statements. Always record less liquid assets. Liquid means that have lower transactions in terms of cash. Then you record more transactions or components of financial statements that are liquid in nature. Okay. Now, loan. A key concept of loan is that the capital that we are raising is a liability amount, and if you're paying it off, it reduces the liability. So first double entry, if I'm just looking on the discussion of a loan, if I'm taking a loan, that is an increase in liability. So loan taken is an increase in liability. If there is an increase in liability, what do we mean by that? Increase in liability basically means now there will be a situation where we are having a credit entry. So loan taken is normally recorded as credit. Right? Now, if you are getting loan, basically it means we are getting money. If you are getting money, you are getting it from bank, right? So bank will be debited in by the same amount. Right? So I believe that this is clear to you guys in terms of double entry. Now, for the interest, what is happening in interest? In the interest, we are having an expense. So when we pay interest, it is the expense, right? So whenever the expense increases, we have a debit entry. So interest will have a debit position, and for interest we are paying it through cash. The cash will be credited, right? Now, if you're repaying the loan, repayment of loan means that the liability is reducing here. Repayment of loan. That means basically we are paying off the debt. So it is a reduction in the liability. Once a liability is reduced, it is going towards the debit side entries. Liability reduction means loan, liability debit, and we are paying it off by cash or bank. So we are going to record it as cash or bank credit because it is an outflow of economic resource. So in your loan situation or liability situation, normally these are the double entries that we are having. Okay. Now we have a situation here. Situation says that there is a garden supplies company that borrowed a loan of 30,000. Loan has been borrowed of 30,000. That means the first double entry should be a recording of the non-current liability. So bank debit by 30,000 and loan liability created, a non-current liability created by 30,000. Okay. A second thing, what does it say? The question says that it repays loans in monthly installments of 350 rupees, of which 50 is interest. So what is the situation? Its situation is that you're paying 350 rupees each month, out of which 50 is interest and the amount is 50, and we are having the principal capital, the amount that we took as a loan, we paid off of 300 rupees. So clear segregation is in front of you that 300 is paid off the capital that we have taken, the amount that we have taken, and 50 is paid off as an interest. So what is the question asking? The question is asking us that we have to show the first 2 monthly payments. For the first 2 months, we have to pay the payments. First of all, we took a loan, we recorded the loan. Okay, month 1. Month 1. What is happening in month 1 shows, first of all, what is the double entry here? What is the situation here? First of all, the situation is that we have paid by the capital by 300 rupees. Okay. If I'm paying by the capital, that means it is a reduction in the liability. So here liability is reducing. Once the liability reduces, we have a debit entry. So we are going to say loan debit by 300 rupees. Okay, because the liability is reducing. Now again, what we are paying 50 rupees as an interest. So interest is an expense, and whenever an expense incurs or is rising, the double entry will be on the entry will be on the debit side of 50 by the name of interest. Now to pay off these two things, the 350 that is going off is coming out from our pockets. That is the cash. So cash is an asset. So asset is reducing here. So the double entry is going to be cash credit by a complete 350 rupees. So you see, this is the same transaction that we have studied. The two transactions we have studied can be done separately as well, can be done in a similar one go as well. These three transactions, basically these three double entries, the entries you are seeing here, that you are seeing as three, can be written separately as well. How separately? Like the ones I've written here. I could have debited the interest and credited cash, and debited the loan and credited the bank as well. So 4 entries can be combined as well. Combination of these entries are written in front of you. You can write them separately as well. Both are acceptable in nature. Okay. Now, if we repeat this transaction again, if we write it as month 2, all the transactions are going to be the same, exactly the same. The amounts are also going to be the same. That is going to change. So I'm just writing it for 1 month so that we can save some valuable time and apply it in more important ways. Now coming towards provision. Now I've discussed provision with you. Provision is an estimate, right? An estimate to do what? To basically record a future expense that is going to come in the business. So if a future expense is coming in the business, then we have to make sure we have to be able to be in a position where we can anticipate it, where we can basically have a particular mindset set or a particular preparation done for it. Right? A preparation can be done. How preparation can be done? By basically anticipating the expense. Once we are able to anticipate the expense, we are able to be in a position where the particular expense can be gradually recorded in your particular financial statement. Gradual recording means basically having a particular amount anticipated by us, amount established by us, and recorded for the further preparations. Okay. So now provision is a liability of uncertain timing or amount. So in the future, if some amount comes up to us, now let's say an amount is coming up, let's say in the future, you say that we have a legal case upon us. We have a case upon us. So what would be the compensation here? The compensation here will be subjective, right? It would be subjective of us. It could be 100,000. It could be 200,000. Right? And will it be in 1 month, 2 months, or 3 months? Is it certain? It is not certain. It is a subjective thing as well. So if it is a subjective thing, that means basically we cannot be fixed amount or time at a certain duration. Okay, it can come in the multiple durations or 1 year, 2 years, 3 years, and the amount can be fluctuating as well. So it is also an estimate, but for the future of any expense that is there or a liability that is coming up upon us in the near future. Okay. So if I say that there is going to be a particular transaction that is having uncertain time and uncertain amount, basically it means that we can just have a estimate of it. It is not a fixed thing to happen. Okay, it might not also happen. Circumstances can change as well. So the main difference between a liability is certain and provision is uncertain in nature. Now for the recognition of a provision, this is the core of what we have to learn. For the definition of a provision, we are going to recognize it only if we have a present obligation, if there is a case on us, or there is something to be happening on us and we have an obligation. we have a probable outflow of economic resources, and we can estimate it reliably. Okay, so it is not like that you are just moving in the blind. You have to have a reasonable estimate for it. Now, for the first part, if I talk about obligations, obligations can be of two types. A legal obligation. Legal obligation is any obligation that is based on law, based on business practices or legal practices that are being there in a particular business. As per the law, if there is any kind of rule that is applied on us, it is a legal obligation upon us. A legal obligation can be of any type, such as your court case, it could be for taxation fine, it could be for redundancy, etc. etc. Now, constructive obligation is the second type, that is a thing that you might not have heard of. Constructive obligation is basically an obligation that is on a business, and the main purpose of constructive obligation or the main idea of constructive obligation is expectations. If a business has a practice or a general activity and expectation developed in their stakeholders, now in a situation, they will be having a liability to or a particular obligation to do this again. Okay. Constructive obligation, in simple words, is basically a practice done by the business that develop an expectation in the minds of the other party. Okay. And it is obvious. An example can be a shop regularly refunds dissatisfied customers. So if a shop is having a practice of refunding the dissatisfied customers, and one customer comes in and he says that I want to refund it because I am dissatisfied, and the company refuses it, they cannot, because the other party can now sue it that they have not fulfilled their constructive obligations. So even without a legal obligation, it must recognize a provision for expected refunds that can come from customers who have bought the goods from them. Okay. Now, when we have identified the particular two areas, now how should we recognize a provision? The measurement of a provision. Measurement is based on best estimate of expenditure. Now, the word coming is in estimate because it is talking about the future. Future can be uncertain in nature. Okay, so uncertainties exist. That is why it can have multiple changes. So whatever the best estimate of the best information you have right now, make an estimate regarding that. Okay, in the future, if the circumstances change your estimates, and the estimates then will be adjusted, and the calculations are going to be adjusted as well. Now, for the first part, if I see that there is 95,000 sales and 3% is to be returned to us, we can easily record a provision that 2,850. 2,850 is the amount that can be refunded to us, or this is the amount that would be required by us, to pay back to the customer. Now, if I want to record a double entry for it, a double entry for it can be easily recorded. How can we record double entry? Now, once we know the amount, can we say that a provision is a liability of the future? Yes, we can. So if it is a liability, whenever we have a provision, the liability increases. Whenever liability increases, we have a credit entry. So the provision here is going to be on the credit side. Okay, that is 2850. Now tell me one thing. If you're going to have a future loss, they're going to have a future loss, there is going to be an expense from a side. We have now the sales that we have made. Have we earned more money from it? Yes, we have earned money from it. If we have earned more money for it, if you have earned money from it, if we are returning it, the profit is going to reduce. That means we should recognize an expense for the particular area. The profit is going to reduce. So expense can be recognized here. So expense will be your you can add by the provision expense, or you can directly record it as expense debit by 285. So to record a double entry for provision, the double entries are debit provision expense and credit provision liability. That is going to affect each of the financial statements. Expense is going to affect the income statements, and the provision will going to affect the SOF. Okay. Another example that says that you are having 60% chance of having a cost of 120,000, 25% chance of having 100,000 as a pollution cleanup cost, and you're having 15% chances of 60,000 being coming up as a fine. So if I have multiple situations, what should I do? I should take all of them and convert them into the best estimate. So what is the possible way of it? So 120,000 into 60% plus 100,000 into 25% plus the third is 60,000 having a 15% chance. So what are you saying? They are saying that all of these amounts have a different percentage, different chance of being occurring. So if there's a different chance of them occurring, I have to take all the chances, add them up, and make sure that I am reaching 100% estimate of these particular transactions. So if I just add them up, the answer is going to be 120,000 plus 2,000. So I'm getting approximately 106,000 as my estimated overall expenditure for the particular transaction. So the double entry is going to be debit the expense, credit the provisions. So again, whenever we are having provision, the first recognition number one, debit expense, credit provision. This is the origin of a particular provision being there. So recognition is according to this scenario. Now, when we are paying off an expense, when we are paying off a provision, when we are paying off a liability, payment means reduction in the liability. So in number two situation, when we are paying off a liability, what will happen? The provision will debit. Provision will debit because our liability is reducing here. Here liability is increasing, expense is increasing. So we are recording it. Now in this situation, liability is reducing, but with the liability, our cash is also reducing because we are paying from a pocket or our bank account. So our asset is also reducing. So a credit entry for that. In the third situation, if a provision is increasing, increase in provision. If we have an increase in provision, what will happen in that situation? In that situation, in number three, we are going to record a double entry where we are having debit expense and credit of provision. Simple as that, as the initial recognition. But what will happen if you're having a reduction in your provision? If you're having a reduction in your provision, if you're having a reduction in the provision, what will happen in this scenario? In this scenario, you are going to have a double entry where liability is reducing. So we can be sure that liability is reducing. So provision will be on the debit side. But what will be there on the credit side here? Now we are not paying off cash, so it cannot be on the credit side. Now we are not getting any economic resources going out. A liability is reducing. That means initially we would have recorded an expense. If a provision is decreasing, in the previous times we might have recorded an expense like these entries. So in this situation, if an expense is recorded, income statement is debited, our profit is reduced. So if our provision is reducing, we are going to increase our profit. To increase profit, we are going to reduce expense. To increase profit, we are going to reduce expense. If you want to reduce an expense, the credit entry will be passed here, where we are going to write profit and loss or P&L credit 578. This is the complete area where double entries can be recorded for the particular situation of provisions. Okay. Now let's go to a question that is given to us and see what does it require us to do. So in this particular question, what does it say? It says that Bright Windows is involved in a legal dispute when one of its customers, who is claiming damage which has been estimated at 100,000. So estimated expense is 100,000 here. Although its lawyer has previously advised that the claim only had a 40% chance of succeeding. They're saying that there's a 40% chance that we might succeed. There were new developments in the case shortly before the business year end. The owner of Brighton Windows has now been advised the claim will probably succeed. Now they are saying that the claim will succeed. The claim will succeed. Okay. Now heirs are important for us. A provision for the damages of 100,000 is recognized in the accounting year-end 2004. Okay, first of all, 100,000 estimate was made. Okay. Now, first of all, if we are having 100,000 estimate, if you're having 100,000 estimate of losing the business, okay, if you're having 100,000 estimate here in this situation that we are going to lose the case, that is a provision for us, right? Now, if there is a provision for us, how should we basically record it, or how should we basically go for it? In the particular situation, first of all, we were told that 100,000 loss is there, and the legal team told us that there's a 40% chance of succeeding it. Okay. Now, let's read the case and record the particular provisions. Estimate of 100,000 is made. That means a provision should be recorded for it. So how should we record the provision? The definition is debit expense by 100,000 and credit a provision by 100,000. So initial recognition is done here. Okay. Now, what is the requirement in the question? Let's read that. First of all, show the accounting treatment for year-end 2004. I have shown the recognition of 100,000. Now, for the question, it says that in year-end 30 June 2005, there was an estimation reduction. The estimate was reduced to 75,000. Now they're saying in 2005, the estimate reduced to 75,000. That means initially it was 100,000. It moved towards 75,000. That means there is a reduction of 25,000. So if there's a reduction in the provision, how should I record that? If I am having a provision reduced in, this is number one. In number two, I am having a provision reduction. In the reduction situation, I know liability is reducing, so debit provision. And by how much? 25,000. Okay. And credit income statement. Because I originally recorded the expense of 100,000, it should have been recorded at 75,000. So I am going to credit income statement by reducing the expense by 25,000. So at the end of the year, what is happening? If I make a T account here for provisions, it is a liability. So provisions, original amount should have been on the credit side. So BT should be, opening balance should be 100,000 on the credit side. And there is a reduction. The reduction is known by income statement of 25,000 that is going on the debit side. So the closing balance here will be, the carried on balance will be 75,000 in order to balance the particular T account. So the next year's opening balance will be 75,000. Okay. Now what does the third requirement say? Third requirement says that the settlement is made in July 2005. Settlement is made on what amount? Settlement is made on 100,000 amount. So if the settlement is made on 100,000 amount, that means first of all the provision increased. Right? By how much? 25,000. And we settled the case by 100,000, or we settled by 75,000. If you have settled it on 75,000, then in this situation we have paid it. So in year 3, we have paid it on 75,000, assuming that we have paid on 75,000. So what is happening? If you have paid it, that means basically the liability is finished, liability is reduced. So we are going to debit our provision by 75,000 and credit our bank because it is going out of our accounts. So by 75,000. So in the provision account, what I'm going to do is I'm going to record debit entry where on the debit side I'm going to write cash because I'm paying by cash by 75,000. So there will be no CD. CD will be zero here because the debit and credit side are balanced here, and this account will be at the end. This account will be showing a zero balance at the year end. Okay. So with this, I believe that the treatments of your particular provisions are clear with you guys, and I believe that the concept of difference between provision and liabilities is clear to you guys. You don't have any questions. If you have any other questions, the WhatsApp group is always available, and I'm available for any other discussion as well. In the next lecture, we'll be practicing some more questions. We'll be going forward with some other areas as well. So till then, enjoy learning. Goodbye.